we've got this unbelievably awesome fixed income sleeve that we've been managing for several years, and we're super excited about it because we've had some great results, and we've made several tactical changes over the years. And this, by the way, is a sleeve of ETFs. So this is the really a very large amount of AUM across our client base with the many advisors we work with is in this sleeve, because whatever percentage of their each portfolio model goes into fixed income, almost all of those fixed income dollars are flowing into this bond ETF sleeve. Now we create, obviously, municipal bond, individual municipal bond and individual corporate bond portfolios as well. But those are, less common than just your, standard 60-40 portfolio where 40% of the dollars are going to flow into a more standard bond portfolio. So this is a very popular, very highly used sleeve. We've had great results. We're very proud of this portfolio. And we've had some situations with other firms that we work with where, we've essentially done some research, put together some alternative fixed income portfolios for some of the RIAs that we work with. And to be honest, when we do it, we're kind of scratching our heads sometimes because we're looking at the results of our fixed income sleeve, and it's just done really, really well. So we want to illustrate that value today and kind of bring to life the tactical changes that we've made and make sense of our logic and what goes into the tactical management of this portfolio. So with all that being said, I've got Ethan Dunbar and Nick Cargill on with us today, a couple of brilliant young minds in the field of finance and portfolio management. And we're going to kind of go through these moves that we've made in the past and then cover what our numbers look like.
Sounds good. Another thing I was going to add to that, Landon, is just the underlying positions are ETFs, like you mentioned. They're also fairly passive and cheap ETFs. Where we're providing the extra value is the active and tactical management over top of those ETFs. So we'll trade in and out of them tactically, and we'll go through some of these examples today. But the underlying expense ratio of the actual assets that are being used, in this case ETFs, are very, very cheap. So just something to keep in mind.
So for the audience, we might say, let's say that the underlying ETF expense ratios are probably under 10 basis points, and then we might charge 15 to 20 or somewhere in that ballpark to do our tactical overlay.
Right. Most of them are under 10 basis points. Some of them can be slightly higher depending on the time. Like, for example, high yield occasionally can be a more expensive position to get into. But yes, that's exactly right. And we like to do that so that we have a really clear picture of what we're allocating towards when we make our tactical moves, and not have deviation from the underlying, let's say, active managers within high yield that maybe would throw off our duration target or overall credit quality target. So we use those passive funds so that we have a really pure access to what we're trying to get access to.
That makes complete sense. And just to wrap, so then I know that some of the funds or some of the ETFs might go above 10, but let's just say the average is around 10. So our advisors for their clients would be able to be all in for a very nice tactically managed bond portfolio at, let's say, 35 basis points, somewhere in that neighborhood of 25 from us and 10 on the underlying ETFs. Is that about, am I in the ballpark?
We're actually sitting at about 7 basis points for the expense ratio on the underlying funds prior to the move we're going to talk about later with pulling some out of high yield. So I think it might go down a little bit, but currently sitting at 7.
So advisors, we're talking about a very nice performing, active, tactical, depending on which terminology you want to use, bond portfolio, all in at, let's say, 35 basis points. So very, very competitively priced. And then as you see what we've done and what the gross returns look like, I think it'll come to life nicely. So proceed, Ethan. Sorry to get off track there.
No, sounds good. Perfect. What I wanted to go through today was a timeline of really the last 4 years, November 2020 through November of 2024 and highlight some of the changes and then how that has affected the performance of the underlying assets in the portfolio as a whole for those last 4 years. For anyone that's interested, we have data going back much longer than just the last 4 years that we've been managing this portfolio. But today we're just going to dive into these 4 years here because we made some pretty meaningful tactical changes throughout this time period. So I can start going through that now if you'd like, Landon.
Yeah, that'd be great.
Sounds good. For the timeline here, I put together, there were 4 major moves that we've made. One of them just wrapping up here in November of 2024. There were some little other tinier trades for those investors that have been involved in this portfolio for this time period. You'll know that we rebalanced and traded more than just these 4 times. But these are the 4 major meaningful positioning changes that we've made. And it started in 2020 when we saw the extremely low yield environment that we were in, and the potential for one, yields to rise drastically, and for bond prices to then fall, and inflation to be a major risk to the portfolio. We added about 20% to floating rate and our TIPS exposure at 6%. So 26% of the portfolio, just over 25% of the portfolio was in a kind of a protection mode, if you will. And that lasts from November of 2020 all the way through October of 2022, when we started to cut our floating rate exposure, cut TIPS, and start to add back to more risky fixed income instruments. So that was October of 2022, reduced, and I have all the positions here in a moment that we can go through the modeled returns and everything that we did. But we cut in 2022, cut floating rate down to from 20% down to 5%, cut our TIPS, so 75% cut on floating rate, and then a 50% cut on TIPS, and then started to ease back into the market by adding to short-term corporates. And then in July of 2024, we essentially cut all of that and went heavy in on duration. And that's really our positioning. That's been our positioning for the second half of 2024. We completely removed the floating rate exposure, reduced short-term corporates to 5%, and added to long-term corporates, bumping our duration target from, prior to July of 2024, our duration target was somewhere just above 5 years. The AG, which is our benchmark, has a duration target just above 6 years, and we lengthened that in July of 2024 to a duration target of just above 7 years. So that was the major move. That was kind of the cycle, if you will, from November of 2020 through July of 2024, and how we played with the duration to protect us during periods when we thought the bond market was at risk, which it was. 2022 was the worst year on bonds on record for a long time, and then kind of swapped. Now we're in the kind of the flip side of this, and we're kind of waiting to see how the next couple of, let's say, 12 to 24 months play out with this higher duration target in the portfolio. And then the last piece of adjustment that we made was recently. We're actually in the midst of trading towards this target right now, but we cut high yield exposure by about 75%, and that was based on the extremely tight credit spreads, high yield credit spreads that we have right now, in the expectation that that high yield has kind of run its course, and more highly rated bonds, less credit risky bonds, are likely to provide a better positioning, at least a risk adjusted return going forward for the next period of time. So anyways, that's kind of been the timeline for the last 4 years. And I can go into some more detail on each of these timelines and what the performances look like, and what the positioning looks like. But that's the overall kind of picture for the last 4 years.
Yeah, no, that would be perfect, because that gives a nice little overview of what we've done. I think you've got prepared, like what were we looking at, what data were we looking at during each of those moves that gave us what, essentially what we needed in order to make those adjustments, and then the rationale behind it.
Yes, yeah, exactly. And What I would say, focusing back on the major move, the big thing that's added to performance here has been adding floating rate and protecting on the downside. So that's this period right here, 11/3 specifically, but November of 2020 through October of 2022, we saw the extremely low yield environment with the very high potential for high inflation as a major risk to bond portfolios. We all know that bond portfolios, one of the biggest issues for a bond portfolio is inflation. And inflation plus an already low yield environment that we were clearly in 2020 and in 2021 as well, was a dangerous positioning for bonds. So that shift into floating rate, I mean, I wish we could have only done more.
Uh-huh.
If we would have had perfect foresight, we would have had, almost all the portfolio in floating rate and tips. But that move was really, that's the biggest, that kind of prediction, and then that move was really what captured a large amount of the performance alpha that we created. And it's kind of funny, like this period of time right here, this is our modeled returns in Bloomberg, and that period from 11/3/2020 through October 11th, 2022, we still had a negative return because we still had assets that had risk to rising yields and inflation risk. But we just were able to overperform by not going down as much with that buffer we put in. So we outperformed by just over 4% during that period, by protecting more of the assets in the portfolio on the downside than the ag. And that's what we have here. This line item here is our portfolio, our modeled portfolio returns in Bloomberg. And then this is the Bloomberg Aggregate Bond Index, the second line here, that was down 15.53%. So that little over 400 basis points of outperformance during that period of time, which was the most important move we've made thus far in the last 4 years, is how things played out. And that's some of the reasoning why we made that decision.
Gotcha. That makes complete sense. And the results were, I mean, it's hindsight now, but that's what it's all about, right? We made some decisions not knowing exactly what was going to happen, and the results were favorable.
Right. We were a little early, to be honest. So we made that move to a much more protectionist portfolio in November of 2020. But the bond market really peaked. If you look at price, they just treat the bond market like the stock market and look at prices. The bond market really peaked in more the second half of 2021 before it started falling. And 2022 was, obviously the worst year on record in a long period of time for bonds. But we were slightly early, but at the time, our investment committee discussions were all, we would rather be early than late on something like this. So that was why
It
we
almost
pulled the
seems like
trigger
that's
then.
no doubt. It almost seems like that's the only way to do it.
Right.
You're always going to be a little early or a little late. I mean, if we could time it perfectly every single move, that would be phenomenal. But that's a conversation we've had internally a lot. Is I think that one of the big things that has added to our um, the nice results in our various portfolios is just the willingness to not be perfect, right? In other
Right.
words, we see something coming, we see the writing on the wall, we can make the adjustment now, and maybe live with underperforming for 3, 4, 5, 6 months because we know we're probably not timing it perfect. But at the end of the day, you take the longer time frames and look at the results, and no, not perfect timing, but pretty darn good.
Right. Yeah, exactly. And that leads into some of the next discussions here. We started easing back into duration. Um, with some unknowns on exactly how things are going to play out. But we've still been able, we've still been able to capture some alpha even during this period of time where I would say we haven't experienced the full recovery of the bond market. We definitely haven't, and we still have room to run there. Um, we haven't experienced the full benefit of adding back duration yet, but we've still been able to capture and clip some difference in return here by being tactical on it. And that's another thing in this portfolio. We haven't this is not designed for us to take, find our biggest bet and just go all in on that. We still are trying to be a core bond portfolio, a diversified bond portfolio. Um, but and not, for example, if we think, for example, now we're not so attracted to high yield, we don't all of a sudden um, even eliminate high yield completely. We cut it by 75%. We don't necessarily start shorting high yield bonds, right? We're trying to be tactical, but also keep in mind that this is we're not always going to have perfect timing. We're not always going to be perfectly right. We're just trying to be tactical within reason, and manage a really high um, really high conviction, but still diversified bond portfolio.
Yep, makes sense.
So a couple other time periods to look at here from October of 2022 to July of 2024. We started the lean back into duration, cut the fixed income, or cut the floating rate portfolio. Still were able to outperform by about 300, a little over 300 basis points during that period of time. During October of 2022 to July of 2024. And then, the more recent time period here, we've still this is a really short period of time, but July of this year to November 21st of this year, again, leaning heavier in duration, even more than we did before, and still, capturing some of that, still able to capture some alpha and provide some outperformance. And it kind of ended up with this is kind of how it ended up for that 4 year period, or just over 4 year period, where our portfolio, this is the modeled returns in Bloomberg, and for anyone who's interested, we can actually provide real returns as well, but just for simplicity today, this is the modeled returns in Bloomberg, which maps out every rebalance that we make, every trade that we make. But we outperformed by almost 10% during that period of time, with a positive 267 basis points during that 4 year period, and while the ag was down, over 7% during that period of time.
So that 4 year time frame is almost a 10% spread in our favor. And if I remember, I know we didn't go back, but I think since inception we're close to 200 basis points above the ag.
Around there, yes, and that is an average annualized. That number you're referencing, Landon, was the average annualized difference. But yes, that's correct.
So we got about 200 basis points average annualized return above and beyond the ag, and that's going back. I know it's close to a 10-year history, but I know that wasn't the focus for today. But I'm sure everybody listening is probably wondering that. So not quite a 10%. 10% outperformance number going back to inception, but a nice, couple hundred basis points of excess return above the benchmark. So we've had really, really nice results.
Yeah, absolutely. And hopefully we can keep that up. That's our most recent move here. Is now we're kind of leaning more into duration and quality, and we cut high yield from about 12% in this portfolio. By the way, we have some moderate adjusted portfolios that are similar to this portfolio, but are slightly more aggressive or slightly less aggressive. But this is the core one, and across the board, we cut high yield by about 75%. So we'll hope that play pans out as well. But like I said, it hasn't. We're just trading to this target now, cutting high yield exposure and leaning into duration and quality.
That's right. So that story will play out over the coming months, and then we'll be able to report back the results of that tactical move as well. But I think from a financial advisor's perspective, everybody's always trying to pull as much. We want as good a performance as we can possibly get, net a fee for the client base, right? And so a lot of times advisors end up in these situations where, they might be posed the question of buy a fully passive bond portfolio, which a lot of times doesn't sit well, or use an active bond portfolio, and they might have to pay close to 100 basis points for that active manager. which in a yield environment like what we've had over the last decade, it's hard to overcome 100 it's hard to overcome 35 basis points, right? But the number, as that number goes up, it becomes harder and harder year after year to perform net of fee. And so that's the big selling point, I think, from everything that we do from a portfolio management perspective. We're always looking at all of that real life information, right? So, if we had to charge 300 basis points to manage this portfolio, well, we would have eaten all of the excess return going back, since inception, right? But since we're all in at a very reasonable number, I think this is a wonderful solution for advisors that are looking for an active approach that's fairly priced, that gives them the potential for alpha. We have experienced that alpha. It's real life. It's not just simulated, hearsay. So we're obviously biased, but I think this is about as good of a bond portfolio as any advisor could ever wish for. And here it is. It's ready to deploy at any time. Call us and we'll do it. Yep.
Absolutely.
All right. Awesome. Well, I see you got the summary screen up here, but you may have already covered all the information in there. I'm not sure.
Yeah, I pretty much covered all that already, but yeah, that is the summary. In case
Awesome.
anybody's interested in this slide deck, we can send it out. But absolutely, I think I covered it all.
Awesome. Perfect. Great stuff. Well, thanks both Ethan and Nick. This was great, and we just hope everything continues to move up and to the right from here, from this portfolio's perspective. So far, so good. So
Absolutely.
Great work, team, and thank you very much.
Thanks, Landon.
Thank you.
Thanks, Nick.